After a decade and a half of helping people invest and retire successfully, we've seen a lot of mistakes. So here are the 20 most common mistakes and the key lessons to know so that you can avoid them and then you can become a better investor. Now, all of these come from the CFA Institute and the images are from Visual Capitalist. I'm going to fly through these, so you might want to click pause or rewind if there's any that interest you and you want to get a closer look. Number one, expecting too much. Remember, investing is a marathon, not a sprint. So setting realistic expectations is important to help prevent disappointment or any bad emotional decisions. Number two is no investment goals. So for retirement, your investment goals, it's not just about the highest return anymore, most likely, but it's more about preserving capital and generating stable income. Number three, you've heard it before, it's not diversifying. We want to be prepared for any of the 4 economic seasons. So we've got to have asset classes that historically do well during each season. That's important. And I'll include more on that strategy coming up. Number 4 is focusing on the short term. It's easy to get influenced by the most recent news or the movements happening in the market. But remember, we're planning for decades. We're not just planning for days. This is an image from Behavior Gap, which makes a lot of sense. Number 5, and that's buying high and selling low. It sounds simple, but this continues to happen every year. Another one from Behavior Gap for this, right? Greed, buy, fear, sell, repeat that until you're broke. And having one way to lower this risk is have a one-page investment policy statement that can keep you on the right path when emotions are high. Number 6 is too much trading, because excessive trading can lead to higher costs and taxes. Taxes especially. I just saw an article where Fidelity shared data around investor success, and the best performing accounts that they listed were the ones held by dead people, meaning there was no activity in the accounts. And then the second best people who had results were people who forgot they even had an account there. Next is paying too much in fees. High fees can eat away at your retirement savings. At Streamline, we've found that the low-cost investment options out there, they also allow us to have proper asset allocation exposure as well, because every dollar our clients save in fees, that gets added to their investment return. Number 8 is focusing too much on taxes. Now, I talk about tax planning a lot because this is where there's some real value in retirement planning, but we want to make sure that the tax tail isn't wagging the dog. Sometimes we see estate planning attorneys help clients save taxes, but the strategy that they're implementing isn't the best thing for their family. Now, before I continue, let me know if you like this kind of video by clicking the like button. It helps me find out what kind of videos I should do more of on this channel. Now, number 9 is not reviewing regularly, because regular portfolio reviews are essential to ensure that your investments are aligned with your retirement goals and risk. And speaking of risk, advisors often invest for clients based on their risk tolerance, but risk tolerance might be different in, say, March of 2020 versus December of 2020, right? We take a different approach at Streamline, where we design the income plan first, and that just tells us how much risk we need for the plan to be successful and have the highest chance of success. Next is not knowing your performance. So tracking investment performance is important and making sure it's in line with the goals that you've set on the plan. And then next is, this is a big one, right? Reacting to the media. The media helps us make bad decisions. They're really great at increasing our emotion, which causes people to not make logical money decisions. So just be careful there. Then number 13, forgetting about inflation. There's this risk that's actually called sequence of inflation risk, that if it's not built into a retirement income plan, it can drastically change the outcome. And I'm going to make another video on this certain risk and how to make sure you're prepared for it. So be sure to be subscribed if you're interested in that so you don't miss it. And then next we've got trying to time the market. Market timing rarely works, especially for retirees, and just consistent investments often yield better results. And this is just an example, if you've seen one of these before, and it's if you're invested all of the days of the year, or if you miss the 10 best days, the 20 best days. This is, you might want to take a look at this also on Visual Capitalist, but just the proof that It's not about timing the market, it's about time in the market. And then the next one, they're related, and it's around due diligence and then working with the wrong advisor. If you're starting to notice that the strategies required for a successful retirement moving forward is different than the last 30 years of saving and accumulating, then finding a retirement specialist team could make sense. A team that's focused on those three essential areas I've talked about: investment, and then tax efficient withdrawal strategy, that's income planning, and then tax reduction strategy. I'm biased, but I would say look for a team who's got CFP professionals, CFA charter holders, and then even those ones that say RICP, Retirement Income Certified Professional. Then moving on to 17 is investing with emotions. We talked about it. Stay disciplined. Don't let fear or greed drive your investment decisions. I love this guy, Carl Richards. And this is just his drawing on increase in mistakes. As the emotional attachment to an investment increases, so do the mistakes. Next, 18, chasing yield. So high yield investments often come with high risk. So a great plan is really going to balance that need for income in the plan, but also with preservation of capital. We really believe in having both of those for a successful retirement plan. And the next is just never starting, right? The best time to plant a tree is 20 years ago. The second best time is today. And then finally, not controlling what you can. So focus on what you can control, like savings rate or expenses or withdrawal rate, rather than stressing over market movements. And there's really more here I wrote this down or typed it up, but these are the things we can't control, right? The markets, the inflation, interest rates, news, what the Fed's doing, tax laws, elections. But if we can control these things, they actually help mitigate the risk of all the things over here. That's your allocation. And you actually can, with tax strategy, you can control how much you pay. Expenses and fees, you definitely can. Your spending, your behavior, and then news consumption. Sometimes we recommend a media fast. Speaking of controlling taxes and costs, check out this video on how to minimize taxes on investment gains in retirement, even if you have a high monthly need, an expense need. And then I'll see you in the next video.